In this video, you are going to learn about the story liquidity tells you. Because what exactly does liquidity tell you? Well, it tells you what the next target is. And you can know the next target if you know how to confirm a sweep versus a run. So you might already be familiar with what a sweep of liquidity is versus a run on liquidity, but you might not exactly know how to confirm it exactly. So I'm going to give you a simple framework on how to confirm it. Now, on top of that, it tells you an institutional story, at least how I like to interpret it. On top of that, it tells you the trend as well. And that trend, whether we are bullish, bearish, or consolidating, will allow you to not only capitalize on winners a lot more, it will also allow you to avoid silly losses. Because quite frankly, if you don't understand the story that liquidity tries to tell you, and you are doing the exact opposite of what the liquidity is trying to do, then you will encounter a lot of silly losses that could have just been avoided. This is basically everything that you should know about liquidity. Now, the first thing we need to dive into is, of course, liquidity itself. So what actually is liquidity? If you're already familiar with this, again, this is just a quick refresher as to how I determine what liquidity is. First of all, we have, of course, the swing lows right there. So that swing low, for example, that is what I refer to as liquidity. Then, of course, we also have the swing high right there. So swing highs and swing lows, also known as swing points, are also known as liquidity. So when I refer to, for example, liquidity, I refer to swing highs and swing lows, because above a swing high, there's liquidity. There are orders there. Below a swing low, there's also liquidity, because there are also orders below a swing low. Now, exactly what type of orders and what we're looking at, all things we're going to dive into later on in this video. Now, what most people do miss is that this is also liquidity. That line right there, because what is that line? That is a previous candle low. Below previous candle lows and also above previous candle highs, like we see right there, there's also liquidity. For example, on the daily time frame, this previous candle high and this previous candle high right there as well. Then if we go into the lower time frame, first, let's say we go into the 4-hour time frame right here, we see this turns into a swing high. If we take a look at this previous candle high right there, and we go into the 1-hour time frame, that also turns into a swing high. So previous candle highs, previous candle lows, they are basically swing points, but on a different time frame. I just wanted you to be aware of that, because that shows us how fractal the market in general is. But for this video, throughout this video, we are mainly going to focus on the swing highs and the swing lows right there. Sometimes we'll also focus on previous candle high, previous candle low, but everything also then applies to the previous candle high, previous candle lows, because it's all fractal. So it's basically the same thing. The next question we need to understand is, what can liquidity do? Two very simple possibilities, and you might already be aware of these as well. But let's refresh our mind right here. Okay, so we have this swing low, we have that swing high right there at the top. We mark out that swing high. If we now trade above that swing high right there, again, there's two things that we can do. In this first example, what we are doing is that we are sweeping that high right there. When we are sweeping a high, we are retracing above it right there, and we are rejecting away from it. So it almost acts like this support or resistance level. Now, after sweeping a swing high like that, what we can do afterwards is continue lower to, for example, that swing low right there, and that could be our next target. It's not hard to find examples of this, because this happens so often. If we, for example, take a look at the previous candle highs that we actually marked out, that's exactly where it happens. We trade above this swing high. Once we trade above it right there, we reject away from that swing high to then target lower and to continue lower, for example, towards a swing low. The same what we see right here. Even that might be in the short term right here, but we trade above it, we then reject away from it, and then we reach eventually this swing low right there. Now with this swing low, you'll see we do the exact same thing. So we're also sweeping that swing low. We trade below it right there, and we start to reject to continue higher again. And this happens so many times. So if you're trying to follow along with this video, what I would advise is just open a chart next to this video and simply mark out these swing highs, these swing lows alongside me, and try to follow along with the story. That's the first possibility. So a sweep of liquidity. The second possibility is this one right here. So we have the exact same scenario, right? Except for these last two down candles right there. The exact same scenario. But instead, what we're seeing is that we are continuing higher. So we are creating a continuation. We trade above the swing high, but instead of rejecting away from it to continue lower, we continue in the same direction. This is what we call a run on liquidity. So for example, where we are seeing sweeps of the swing highs right there, at the same time, we are also seeing, if we mark out these swing lows, for example, at first that might look like a sweep, and what exactly the difference is and how we can confirm that, things we're going to dive into in just a second. But eventually we start running this swing low right there. So we trade below it, we create a retracement, and we start running it right there. So we reach below it again. That means that we can continue in that same direction. So we are very likely to keep continuing lower at that moment in time. The same if we trade above these swing highs, and this is actually a very beautiful example of what happened last week even. We trade above these swing highs and we keep trading above them, those swing highs right there. And whilst we keep trading above them right there, we are running that liquidity right there. So that means we can simply keep continuing higher right there. So those are the two possibilities. Every time we trade above a swing high or below a swing low, there's two things that can happen. We can either sweep it or we can run it. It's up to us to understand how to interpret the story in such a way that we can determine clearly, is it a sweep or is it a run? Because that's going to determine the next target. Which target? Okay, let's move on. Sweep versus run right here. Whenever we sweep a swing point, then that essentially means that we are creating a reversal right there. So we are turning around like we just saw, we are rejecting away from it, we are turning around and we are moving towards the opposite side. Whenever we are running liquidity, that means that we are not doing the opposite and we are creating a continuation. So we can continue in the same direction. Again, like we just saw, right? We are running those highs, so we continue in the same direction. We are sweeping these highs, so we have a short-term reversal right there, where a sweep, even if we keep sweeping highs, that might lead to a longer-term reversal where we now start to continue lower. Okay, let's define this a little bit more clearly. So what exactly does this mean? Everything right here. And this is going to be this is the foundation. If you don't understand this, this is the foundation of everything that involves liquidity, essentially, and how we're going to use that story. Now, here we see bearish price action. When we take a look at this bearish price action right here, one thing that stands out is that we have this swing high right there. Now, once we trade above that swing high, at first, whenever we trade above a swing high or below a swing low, it might not be very clear what we are going to do. Are we going to sweep it? Are we going to run it? So usually you just need to wait. You just need to sit there. And I know for us traders, that's quite difficult, but that's part of the game. You just need to wait, sit there, let price develop a little bit more, and then it will give you the answers. So right here, we see that we are creating a larger rejection. Now you might think at this moment in time, this is potentially going to be a sweep because we are rejecting away from the swing high. Now, I created the slides right here. So obviously, I already know the answer of what I created. But the reason why this isn't a sweep and why this does turn into a run is something we're going to dive into a little bit later on as well, how to confirm this. But what we see right here is that instead of sweeping it, so rejecting away from a swing high to continue lower, we are continuing in the same direction. So we keep trading above the swing high. Now, when that happens right here, we are essentially running that liquidity. When we run the liquidity, we know it's a continuation, but a continuation towards what? What are we continuing towards? Well, we are continuing towards the next liquidity area. And that is, for example, the swing high that we see above right there. So when we run this swing high, it's very likely that we are running towards the next target, which is that next swing high above it. So this is where we then continue right here and we continue higher. And this is essentially that area that we have right there, running the swing high and we run towards the next swing high. Okay, let's go fast forward a little bit right here. Now we reach this swing high. So again, when we trade into that swing high, we might not know clearly what we are doing at that moment in time. Are we sweeping it or are we running it? And that's going to determine what the next target is going to be. So right here, we see that we trade lower. And instead of seeing another large up candle for the third candle right there, we see that now we continue lower. This is where this swing low, for example, becomes the target right there. Because we are sweeping the swing high right there, we are creating a rejection from that swing high. So we continue lower, if that makes sense. So right here, because we are sweeping it, that is a short-term reversal right here, where we now trade towards that swing low. This, again, is what we then call a sweep right there. So again, very simply, right? Sweep right there is a short-term reversal. Whenever we run liquidity, we are continuing in the same direction. That's important to understand. So to drive this point home very clearly, what can liquidity do? We can define this. We can define this objectively. The way we define it and right along with this, because again, this might be a lot to take in at first, but it's going to make a whole lot of sense. Just have it down on your desk somewhere, write it down, follow along with it, and it will make a whole lot of sense. Okay, sweep a swing high. Whenever we sweep a swing high, what is the next likely move? again, when we sweep a swing high, we are likely creating a reversal, right? So again, to show you that in a chart, when we are sweeping, for example, this swing high, we are creating a reversal. So what is the next likely move? Well, that means if we're sweeping a swing high, the next likely move is to target a swing low, because we are creating, at least in the short term, a reversal. Okay, whenever we are sweeping a swing low, what is the next likely target? This is just the inverse of what we do when we are sweeping a swing high, right? So it's just the opposite. Okay, that means that we are likely to target a swing high. So what that looks like is, for example, if we trade below this swing low right there, and we determine that we are sweeping that swing low, then eventually this swing high, for example, might become the target right there. Now that's the first possibility, that's the sweep that we went over. Then of course, we also have running liquidity. So whenever we run a swing high, again, it's a continuation, right? So think about what the next target should be. That is, of course, going to be, well, target a swing high afterwards as well, because it's a continuation. Like we talked about with these swing highs, we run this swing high. So that means the swing highs that we see right here, for example, towards the left, those are going to be the next targets. And then when we run a swing low, again, it's a continuation. I think you get the point by now. Then that means that we are targeting a next swing low as well. So whenever we reach a swing point, there's two things that can happen. We can either sweep the swing point or we can run the swing point. And that's going to determine what the next target is likely going to be. So to give you an example of that as well, here we have the exact same price action as to what we were just looking at. When we were running this high to run towards that next swing high, when we were sweeping this swing high and then creating a large rejection to run towards this swing low right there. Now we have reached this swing low. So what are we going to do? Whenever we reach a swing point, you simply mark out the two possibilities. And then we need to confirm which possibility is actually playing out, which we're going to dive into afterwards. So right here, we can either, again, there's always two possibilities, as in we can either continue higher or we can continue lower. So that means we can either reach that next swing high right there, or we can continue lower and reach that next swing low right there. That is going to be determined by if we are running or if we are sweeping it. So when we run this swing low, we are going to run towards that next swing low right there. If we sweep this swing low, we're going to sweep it and we're going to target that next swing high that we have right there. So then the question, and I think this is quite clear for now, then the question becomes, how do we actually confirm if we are running or if we are sweeping those swing highs? Now, just before we dive into that, I need you to understand, again, when we reach a swing high slash low, this is the whole point. We don't yet know what it will do. So keep an open mind and mark out the possibilities like we just mentioned. Quite important. When more candles develop, then we can know, then we can have the confirmation of what is most likely going to do next. So right here, when we have this scenario right here and we trade above this swing high right there. So we continue higher, we have a retracement right here and we trade back above that swing high again. Okay, now right here, at this moment in time, this is quite uncertain. So you might say that this is a sweep, but nothing is confirmed just yet. You might say that this is a run, but nothing is confirmed just yet. We need more candles at that moment in time, or we need more evidence as to what will happen. Now, I'm going to again give you quite a simple framework of how we can know what will happen. So for example, if we are running that swing high, same scenario right here, we have that swing high. If we are running it, we still might get a retracement at first. But now we see that we are stinging back above that swing high again, right there. Okay, we're going to dive into that with more specifics as well later on. If we take a look at a sweep, then we have the same scenario again with that swing high. Now, when we let the candles develop right here, same scenario, then instead of seeing that up candle, we are now seeing down candles right there. So that is when we can, well, say that we are sweeping that swing high because we are rejecting away from it. And we can potentially look to target that swing low right there. So what I also need you to understand is when it's uncertain is in a scenario like this. Same exact scenario, right? But here we are not creating those up candles. We're also not creating those down candles. Instead, we are creating smaller candles right here. Now there's a specific reason as to why this is happening. And the reason why this is happening is at that moment in time, price action is stuck. And why is it stuck? Because it's stuck between two support and resistance areas, essentially. Now, which specific areas? The specific areas right here is that, of course, the swing high that we have right there, that swing high essentially tries to push price lower at that moment in time. But what we didn't go over just yet, which we do need to go over in a little bit as well, is that when we create a retracement like this, what are we retracing back to? Well, this right here is what we call an order block. And right there, we also have a fair value gap that we are retracing back into. So it's essentially a battle at this moment in time between the order block and fair value gap and versus the swing high right there. And based on understanding this, we can now dive into how to confirm it actually. It's all going to make sense. Stick with me right here. Okay, number 2, we're going to dive into the confirmation right there. How do we confirm a run? So that's the main question. And also, how do we confirm a sweep without being vague as to, yeah, if we run a swing high, we just keep trading above it and we continue higher, essentially. It's a bit vague, right? Now, how do we actually confirm it? Okay, the run is quite straightforward. So the run is quite simple compared to the sweep right here. Same scenario, we have that swing high. And we are going to look at a run right here. Now, whenever we look at a run on liquidity, you need to measure the first sting above that high. That's what I like to call the first sting. So whenever we trade above that swing high or below a swing low for the first time, that's what I call the first sting. Afterwards, oftentimes what might happen, and this won't always happen, we're going to dive into multiple examples as well, but we often get a retracement. And that might be a 1 candle retracement. That might just even be a wick retracement, a very tiny retracement. But there is going to oftentimes be a rejection from that swing high right there. And afterwards, this is what we call the retracement then. Afterwards, right here, after we create the retracement, that's going to determine if it is going to be a run or a sweep. So if we now continue higher and we sting back above the swing high that we had right there, then this is what we call the second sting right there. When we create a first sting, a retracement, and a second sting, that specifically is what I like to look at when we are running liquidity. So to draw that out, let's say this right here is a swing high right there. What I like to look at, that first sting right there, we create a retracement or at least a rejection right there. Again, can be a very tiny rejection. We're going to dive into examples. Then the second sting right there. That for me is a confirmation. Now that is based on an institutional story, at least the way I interpret it. Which is something we're going to dive into later on as well. Some very good examples are these right here. Now we see this swing low. If we understand, okay, when are we sweeping it? When are we running it? We see that we have the first sting right there. So the first thing is the first time we trade below it right there. That's the first thing. So to be specific, that's that right there. Now afterwards, we start to create another sting right there. So we get a retracement and we start to create a second sting. Afterwards, we even create a third sting right there. When we keep trading below that low right there, that to me is when we are running it and when we can now determine, well, we can actually run towards these next targets right there. For example, that swing low. For example, we see something very similar with these swing highs. Now this swing high creates a tiny retracement right there, where you can see the retracement through the wicks. So the wicks right there actually are the retracements to then continue higher. Now, that's of course a little bit vague. We're going to dive into that. Here you can see that a little more clearly right there. So we trade into it right there with the first thing, that's that wick. In the same wick, we actually create that larger retracement. Then the next candle creates that second sting right there to then continue higher. When that happens, that for me is that run on liquidity. Now, of course, that won't always happen because sometimes you will have scenarios like these right here, where we just explode higher. So then are you waiting for a retracement or what are you doing at that moment in time? Well, the way I like to confirm my run on liquidity is by going one time frame below the swing high or one time frame below the swing low. So what I mean by that is, for example, if we have a 4-hour swing high, I want to wait for a 1-hour 2 sting to see it a little bit more clearly. Because again, yes, you can see it, right? You can see it through these wicks as well. But again, now we are looking on NASDAQ, we are looking at the 1-hour time frame. So these right here are 1-hour swing highs. So if I now go down the time frame, then I would go into the 15-minute. And on the 15-minute, you'll see the 2 sting more clearly. For example, right here, we have this swing high right there. We see the first sting, we create a retracement, then we have a second sting right there to continue higher. Here, this swing high right there as well, we have the first sting, create a larger retracement that we see right here, and then we create the second sting to continue higher. Now, even with this swing high right here, we see that, well, this one just explodes higher. So at this moment in time, we don't have a clear 2 sting right here on the 15-minute time frame. Again, I don't think I have to explain when it's exploding higher like this. Obviously, we are running that liquidity. But at the same time, what you can do and what I like to do, but again, be careful with this at the start. Just get comfortable first with one time frame below, is I don't mind going lower in the time frame. So even to the 5-minute, even to the 1-minute right there, just to see what we are doing right there. If we are creating a rejection, and if we're not creating a rejection at all, and we're just continuing higher, then I would say, okay, well, we are running those highs. Now, if we go over this example with a swing low right there on the 4-hour, again, what I would ideally do is go down one time frame right there. Here we see we have the first thing, we create a retracement, and we sting back below it right there. When we get to the institutional story, this is going to make a lot more sense in my opinion as well, because that's essentially what it's based on. We are building a free Discord community built by ex-prop firm owners to provide you with unique insights regarding prop firms, how you can pass evaluations better according to data, etc. How you can also get payouts, and how you can stay up to date for your favorite futures prop firm. If that's something you're interested in, to join ex-prop firm owners and other prop firm traders, link in the description. All right, so we somewhat understand how do we actually confirm a run, which again, we're going to dive into later on as well with more examples. The next question is, how do we actually confirm a sweep? In order for us to confirm a sweep, we need to have some extra components. We need to understand a few extra components right here. The first thing that we need to understand is price always has a reason to reverse. So oftentimes we trade into, for example, a certain level. From that level, we then create a reversal. The same if we trade into a swing high, that's where we can create a potential reversal. So there's levels in price. There are levels in price where we can create reversals. That is, for example, because of liquidity. So because of swing highs and because of swing lows. But on top of that, that's also what we call, or what we refer to as PD arrays. And you might already be familiar with this. I'm going to dive into the PD arrays that we are going to discuss right here. They're quite simple. This is important to understand when we move on to how to confirm a sweep. So right here, number one, again, for the PD arrays is things we've already gone over, swing low and swing high right there. Now, number two, the second PD array that I like to use is a fair value gap right there. So the fair value gap. So again, the 3 candle pattern as well, those gaps in the middle of the candles. Number three right there is the order block I like to use. And the order block is quite straightforward because that's when we are continuing high right there. That's simply the retracement that we have before we continue higher again. So you can see, for example, how the order block is also in alignment with a swing high, because whenever we trade above a swing high, usually that also means that there is an order block. Or whenever we trade above a swing high, usually that also means that right here, we also have a fair value gap right there. So they all connect together quite nicely. Now, if we move on right here, again, I'm going to give you the same example. This, at this moment in time, is where it's quite uncertain because we trade into this swing high. So when we trade into that swing high, then that means the swing high at that moment in time might push price lower. See it as every swing low tries to push price higher. Every swing high tries to push price lower. So almost like, again, that resistance level where we try to push lower at this moment in time. Now, if we then create a retracement because of that, then it's not like we can just instantly continue lower. And of course, that might happen once in a while, but oftentimes that's just not the case. So what happens instead is that we create another, well, a continuation or seemingly a continuation to continue higher again. Why is that happening? Because right here, we see that we also have this gray area that we showed a little bit earlier. That's what we call an order block right there. So that's essentially the whole retracement that we see right there before we continued higher and before we traded above the swing high. So from the top right there, when we reach above a swing high, that swing high right there tends to also be an order block at the same time, which is just a full retracement that we see right there, those down candles. At the same time, we also have this fair value gap right there. So it's a battle at this moment in time. It's a battle because the swing high might push price lower, but at the same time, the fair value gap plus order block might push price higher. So there's a lot of might, there's a lot of it may happen, there's a lot of it might not happen, a lot of different possibilities. Well, not a lot because it's just two. We can either continue higher or we can continue lower. But in order for us to determine that, we need to determine right here which side is likely going to fill. Now, sometimes this will happen right here. Same scenario right here, but we see that instead we are consolidating. This is what happens very frequently, to be honest, happens quite a lot. Now, why does this actually happen? Well, the reason why this happens is because simply said, we are stuck. Why are we stuck? Because at this moment in time, the swing high tries to push price lower. And at the same time, we also have a fair value gap and order block that try to push price higher. Inherently, right, if we take a look at price action right here, what makes price go lower? What makes price go higher right there? That's because if we go higher, the bearish side right there is weaker. So from a very logical standpoint, very basic right here, the reason why we go higher right there is because nothing is preventing us from continuing higher at that moment in time. So we are just simply free to move higher. If we continue lower, there's nothing preventing us from continuing lower, and we just continue lower at that moment in time. So the bearish side is stronger than the bullish side. So if you look at this, for example, right here, the reason why we are not going anywhere is because there's something that is preventing us from continuing higher, which is this swing high, and there's something preventing us from continuing lower, which is this fair value gap and that order block right there. So we are stuck. And when we are stuck, we're not going anywhere. So right here, we need to understand that one side needs to fill in order for us to move somewhere. And like I mentioned, this is something that will happen very, very often. Now, this might happen on the higher time frame. And if it happens on the higher time frame, you might get a consolidation for a couple of days. But this might also happen on the lower time frame where you get a consolidation for a couple of minutes. For example, right here, we trade above this swing high right there. Now, when we trade above this swing high, we create a larger rejection back into this fair value gap, for example. Now, on the 50-minute doesn't really look like anything, but if you, for example, are a scalper and at that moment in time you are trading on the lower time frame, this right here can get very confusing because here we start to continue lower, but at the same time we now start to continue higher again. It's very confusing at that moment in time. And what you're looking at right here is simply said a lower time frame consolidation. A great higher time frame example of this is, for example, here on the US dollar. So we trade above this swing high right there. Again, we can potentially sweep it, we can potentially run it. At the same time, whilst we are creating a retracement, we retrace back into the fair value gap right there. And also, of course, this larger order block that we have right there. But for now, for simplicity's sake, I'll just keep the fair value gap just to keep the chart quite clean. Then we see right here for a couple of days, for basically throughout this whole week, we just create a consolidation. And that is because price is stuck. So either this swing high right there needs to fill, or this fair value gap right there plus the order block needs to fill. So how can we actually see that? Okay, let's move on right here. So in order for us to create this sweep right here, what needs to happen? Well, the fair value gap and order block actually needs to fill because that's going to confirm the sweep. So let me explain that more clearly right here. Whenever we mess around a little bit right here, like we just saw, for example, on dollar, like we saw on Nasdaq or ES right there just as well. Then from the fair value gap order block that we try to continue higher from, we tend to create a low. Something along these lines right here. If we now sting back below that low right there, then we can continue lower and eventually the low of the order block can become the target. This is where we are now sweeping that swing high to continue lower. So again, I need you to understand, we confirm a sweep. So a sweep is confirmed when the order block plus fair value gap fail. Sometimes there won't be a fair value gap. If there's no fair value gap right there, high up in the lag, then you can simply focus on the order block right there. But I need you to understand, this might seem quite complicated, but this is a very simple pattern I'm going to draw for you. So let's say we're continuing higher right here. We have a swing high. This right here is our swing high right there. And we don't know if we're sweeping that or if we are running that. So when we create a retracement right now, we might create a retracement back into the fair value gap right there, back into the larger retracement, this order block that we have right there. There's a very simple pattern to it. And the pattern is that let me draw it on the right just to simply show you the pattern right here. Again, that same swing high, same situation right here. We create a larger retracement. If we now bounce a little bit, so we reject a little bit higher from it right here. But we don't reject higher above like this. No, we just reject a little bit from it. And instead, what we do is we continue lower again below this low right here. Whenever we have a situation like this, it's very, very likely that we are going to continue to the low of the order block that we have because that's a swing low, right? So we are sweeping this swing high. Now we have this pattern right there and we are targeting the swing low. So to draw it in this example right here, if we now start reaching below this low again right there, that is where we now look to target the low of the order block, which is this swing low right there. And this pattern happens essentially a lot because when I take a look, for example, at this scenario right here, and we take a look at the dollar scenario, this is where it didn't happen, right? Where did it happen? Because if we now take a look, for example, at this scenario, we are potentially sweeping this low right there. Okay, because we are potentially sweeping the low, we are trading back into this larger order block that we have and this larger fair value gap that we have right there as well. This is even more clearly visible on the weekly time frame. If you zoom out a little bit right here, this is where we can see it clearly with the fair value gap right there. And we also have the larger order block right there. You could even make the argument to mark out that one would have the same results. So right here, what we are looking at is that we are rejecting from this order block and fair value gap to try to continue lower again, to then eventually reach above this high to continue higher. When that happens, this side is failing. So the sweep is now free to move to continue higher. So that's where the fast price action happens. So to draw that first with a line chart, because I can understand this might be a lot to take in as well. Okay, we have this scenario, right? we continue lower, we have that swing low right there. And then here we might be sweeping that swing low. And now we create a larger retracement. This is where, again, if we now continue lower like this, okay, we are potentially running it right there. We are running that swing low to keep continuing lower. But instead what happens, we trade back into the fair value gap, into the order block that we try to push lower from. We are failing to do so because now we are stinging back above this high again. And this is where price is now ready to run to continue higher, ready to run towards those highs right there. That is the specific pattern that we are looking at. Again, we can have a sweep, and a sweep is all right up until we reach an area where price is preventing us from continuing higher. And those are those PDAs. Those are the levels where price can potentially reverse. So to confirm a sweep, this side, the things that are preventing us from continuing higher, they need to essentially fill right there. And that's a specific pattern that we are looking at. Now let's take a look at one more bullish example. For this example, I would like to go a little bit into the lower time frame. So for example, if we take a look at ES right here, we remove a couple of things, then what we're looking at on ES is that we are reaching above this swing high, also this swing high, right? Now, when we reach above that, we have, for example, this fair value gap right there. But more importantly, and that's going to vary from scenario to scenario, it's going to be a little bit different, of course, we have this order block right there. So this moment in time, are we sweeping this swing higher? Are we running it? And the interesting part is now, for example, combining this with a little bit more on the lower time frame. So for example, right here, we don't necessarily get a clear swing low, but we do get that rejection. That rejection is important because what is this rejection essentially telling us? This wick right there, because that's essentially that rejection. If we go back a little bit right here, this essentially is telling us, well, it's trading back into the fair value gap, back into the larger order block as well. It is trying to push higher from it, but it's simply failing to do so if we trade back below the main rejection that we have right there to then continue lower. So from all this, we then zoom out and we combine those time frames. We can then see right here, hey, this is where the target is. That is what now the target is. That's the low of the order block right there. And that confirms a sweep. This is very important to understand because a sweep like that doesn't just happen magically right there. Quite important. And this will give you a whole lot more accuracy. So then what is a run? Well, a run is just, well, again, a run is quite simple because that's just, of course, the opposite essentially. If we take a look at this scenario right here, again, we are stuck between those two levels right here, swing high and also the order block and fair value gap. Then right here, we see that a run is when we simply continue higher. So instead of running this low right there, we start to run higher, start stinging back above that swing high, similar to what we just mentioned with that two sting pattern. So a run happens essentially when the swing high fills. That's it. Now, of course, you noticed at the start that I mentioned everything is fractal, right? So you can get really creative with this because I just mentioned right here from the 4 hour, we have a fair value gap with an order block right there. If I then go into the 50 minutes, to then see this rejection, what is its previous candle low? Well, if we go down a time frame or we go down 2 time frames, no, 1 time frame is enough. We see that this turns into a swing low right there. If you now even go down into the 1 minute time frame right here, then you can see what exactly is a run on liquidity for this swing low. Is we see that we have the first thing, we create a retracement right there, and the swing low, we keep trading back below that. So that is failing. So that right there is where we can now continue lower to target lower towards further swing lows. And eventually the target, of course, becomes this main swing low that we have right there, because that was all part of the larger sweep that we are looking at. But the same right here, the exact scenario that we are looking at. It's a shame that this is just before market close, but potentially interesting to look at next week right here on ES. If this low right there, that's the low that we are currently reaching. Now, at this moment in time, we are creating this retracement. Okay, we know that rejection is quite normal, right? It's going to determine if it's a sweep or a run, what happens afterwards. So what happens afterwards is going to determine if it's a sweep or a run. So right here, we see if we now sting back below it right there, and we trade below it, that right there is most likely going to be a run. And then we can determine, okay, well, we might be running towards, for example, this next swing low right there. But, and if we see right here that we are instead trading back into it, we create this rejection, and then we trade back above that rejection again to continue higher, well, then we could argue, well, these highs might be the targets again. Before we move on, I need you to understand that we, and in MMT in general, what we're doing on this channel is we're always trying to create self-sufficient traders. So this will never really make sense if you don't open your chart and you just mark it out for yourself and you're going to see it for yourself. Please try to do that. Try to put some time into that, because that's the only way how this actually will work and how it will make sense for you. So how you can also do that in your chart is I've created a simple order for you. So first, mark out the swing high / low, where you're trying to determine if we are running or if we're sweeping that. Then the next step right there, what you should be doing is mark out the fair value gap / order block right there. So that is essentially going against the swing high or the swing low. And after that, what we're trying to determine is mark out the highs / low created from them. So from the fair value gap, from the order block right there, seeing if there's some highs or low, or seeing at least if there's some rejection from it. It won't always be a clear swing high or swing low, as long as there's some rejection from it. If that's not there, you just wait at that moment in time, right? Then right here, what you want to do afterwards is the liquidity or the fair value gap / order block failing? So is the swing high / low failing, or the fair value gap / order block? And that's going to determine then if we are sweeping or if we are running it. Because if the swing high or low is failing, we are running the liquidity. It's a continuation. If the fair value gap or order block is failing, then we are sweeping the swing high / low. So it's a reversal, at least in the short term. So to give you a very clear framework of this, again, we have the same scenario right here. I need you to understand everything that happens right here in between at this moment in time is the red zone for me. It's where I don't want to do anything at that moment in time because it's not clear. We have multiple possibilities. It's basically 50-50. You can't get more 50-50 than this because we're trying to push lower, but we're also trying to push higher from the fair value gap order block. So right here, this is the red zone. What we need to wait for is, for example, if we reach above that high right there, then this is the green zone because that's where we are now running the liquidity. So we can run towards a further target that might be above it towards the left. If instead we are going to sweep it, then we mark out that low right there. Again, just a rejection won't always be a clear swing high or a clear swing low. Then right here, what we see is this is the green zone for the sweep. Now, a little bit, I left a little bit of a blank area right there because, of course, just the first thing, you don't necessarily know if we're going to reach below it immediately and run that low to then continue lower, if that makes sense. So right here, if we reach into that green zone right there, that means that we're sweeping it. We can run towards the order block low that we have right there, the next swing low. And this right here is then what we call, again, that sweep. And this is just a whole inception of running swing highs, swing lows, sweeping swing highs, swing lows. Because if you understand right here, what are we doing? Well, we are potentially sweeping this swing high, but we are confirming that by potentially running this swing low right there. Because if we are running that swing low, we can then run towards the next swing low. It's a whole inception of the same exact concepts. But once you understand the same exact concepts, you can get super creative with it. It will just make sense to you, I promise. As you noticed, the further we go into this video, the more advanced it does tend to get. Now, this is where I do want to dive into the institutional story. I'm going to try to explain this in the most simple terms. But again, understanding this will allow you to take this to a next level as well. And it's just a cherry on top, if that makes sense. So what is the institutional story? Well, in order to understand that, we need to understand, well, what actually is liquidity? Well, liquidity are orders, right? So it's buy orders, it's sell orders, essentially. That's what it comes down to. So if we take a look at this scenario right here, then what is above that swing high? Well, above that swing high, there are, again, orders. So there's buy orders, but at the same time, there's also sell orders. You can't have one without having the other, if that makes sense. Again, whether this is, well, we know liquidity, they are orders, but the story I'm about to tell you, that's the way I interpret it before people start typing angry comments. Oh, this is not how it actually worked, how the algorithm works, etc., etc. Leave that be, please. This is how I interpret it. This is what works for me. So right here, this is where breakout traders are looking to buy. Now, breakout traders make up a large segment of the overall trading space. Breakout traders are not the same as SMC, for example, where the average Joe is trading on a demo account, even on a prop firm. So the liquidity is not even that relevant. No, breakout traders are real in the markets. They have real large orders. They're not necessarily retail traders. These are also part of larger institutions and hedge funds, etc. A breakout trader, when we trade above a swing high, they are essentially looking to buy. Now, why is that? Well, because when we trade above a swing high, and well, we could argue we are using a lot of the same rules as well, a lot of the same thought processes, because when we trade above a swing high, that signals that we are strong. Just basic market structure. So when we keep trading above a swing high right there, that signals that we are strong. So for example, breakout traders are looking at this. If we trade above that swing high right there, and that means we are strong, so we can continue higher towards the next swing high. We basically do the exact same thing. And that works very well. That's the same if we trade below a low right there, that signals that we are weak, so we can keep continuing lower. And that works, generally speaking, very well. It works even better if you understand the difference between between a run and a sweep, because this thought process oftentimes also gets used against them. For example, with this swing high right there, you're trying to buy above that right there to then continue higher. Well, that one didn't work. Now, why is that? It's because orders need to be matched at all times. Again, when you're looking to buy a car or you're looking to buy a house, you're buying that from someone, right? So someone else needs to sell it to you. If you're selling your car, you need to find a buyer. So what is important to understand that for every buyer, there needs to be a seller. For every seller, there needs to be a buyer. Now, again, from a retail perspective, so our perspective, when we are trading with a couple of lots, again, even for the most part, that's not even relevant because most of us are trading with prop firms and you're probably trading on a demo account. So it's not relevant because your order never goes to the real market, if that makes sense. But if you're trading on the real market, and even then you could argue that if you're not trading with a whole lot, not large sizes, then that liquidity is still not super relevant. You can just click buy and sell everywhere where you want to, if that makes sense, because your order will always get filled because your order is not that large, if that makes sense. If I'm trying to place an order of 10,000 cars, well, are there 10,000 sellers at this moment in time in my area lining up to sell that specific car that I want? Well, that might take a while, right? That's not going to be easy. But if you're trying to buy one car, I mean, you can just go to the internet and buy one car with the instant of a click, if that makes sense. So the larger orders, the harder it is overall to get a fill in the market. Now, why is this important to understand? It's because we just mentioned right here, breakout traders are looking to buy. They, generally speaking, buy with large orders. So to give you an example of what we already went over a little bit as well. If there are breakout traders looking to buy because we trade above this swing high, and this is their buy order right there, simply because we trade above that swing high. Okay, now there might be a little bit of nuance to the strategy, of course, but that's the main thought process right here. The stop loss might go below recent swing lows right there. And they might target highs, for example. Now, because we trade above those swing highs, we are strong, so we can keep continuing higher. So the order might look something like this, along these lines right here. Now, of course, who are they looking to buy from at that moment in time? Because they don't simply buy at that moment in time. Again, there needs to be an opposing matching order. So on the opposite end, you can imagine something like this. There will also be sellers right there. Now, if in general the market is more bearish at that moment in time, there are more sellers at that moment in time as well, or there are more willing sellers at that moment in time, then what happens is the market will continue lower. But this order, the buy order right there, gets matched with sell orders right there. And that stop loss might also go above these highs. For example, let's say these swing highs right there. Okay. Now, what is important to understand is that when we are sweeping, for example, this swing high right there, we are suffocating the buy position of the breakout traders. Why? Because the opposite sell order, the stop loss, the take profit might go below this swing low right there. Why? Because what is that swing low? That swing low is, again, orders. So right here, in order for these sell orders to play out right there, for these sell orders to actually play out and to hit their take profit right there, they also need opposing orders, right? So they need the stop loss right there of those buy breakout traders, because that stop loss right there is a sell order. This, when you are looking to short right there, your take profit is a buy order. You're essentially buying back a position that you somewhat loaned into the future, if that makes sense, to potentially make a profit. So if we mark this out right here, when you are looking at a buy position right here, the entry is of course a buy right there. The take profit right here is a sell for a buy order, and stop loss right there is a sell order right here. Now, for a short, that's essentially the opposite. The stop loss right there is a buy, and the take profit right there is also a buy right there. So you can see how these orders get matched right there. So what is important to understand is that they need each other. So what happens oftentimes is that when we are sweeping this right here, we are sweeping this high, we immediately go into drawdown for the buyers right there, because we are suffocating the position. Because again, imagine if they continue higher like that, they have a profit and they can slowly start to take profit and minimize the risk. Then if they start taking orders off the table, then this stop loss right there won't be the same anymore, if that makes sense. So that stop loss might not even be there anymore. So in order for these sellers to hit their take profit, this order needs to somewhat be suffocated. So they need to unwillingly sell the position right there, if that makes sense. And this is essentially the opposite on a run. So what I always like to imagine is, what are the breakout traders at this moment in time doing? That's always what I like to imagine. So for example, with this low right here, if we again assume there might be breakout traders right there, and they might cover stop loss above those highs right there. Here we see that we are simply continuing lower, and the breakout traders are now in a profit even. We are continuing lower towards certain targets. So we are running these lows right there, which means there's no need, there's no intent for the opposite end right here, for those buyers right there, to reach the stop loss right there, to actually need that opposing liquidity, if that makes sense. And because we see that there is no need for it, because this order is not getting suffocated in their drawdown, then what happens? Well, we simply continue lower. That's the same way, for example, if we take a look now at this area right here. And that's, again, we simplified this whole process, right, with the previous patterns that we talked about. So if this doesn't make any sense to you, perfect. Just let it sit there for a while. Let it not make sense, if that makes sense. Simply don't pay attention to it right now, and simply let it sink in a little bit and potentially come back to it later. But if you, again, look at this low right here. Okay, well, what are the breakout traders doing right here? Well, at this moment in time, their stop loss right there is actually getting suffocated. So that could mean we might be in need to actually create a larger retracement back to that stop loss, for example. That's going to determine the same patterns we went over, if this is going to happen, something like this right here to keep continuing higher, or if we're going to get a scenario like this right here to continue lower right there instead. So then whenever we are comfortable below a low, or we are comfortable above a high, like we see, for example, right here earlier on, that means that we are running it, because there's no need to match those order with opposing liquidity right there at the bottom, for example, or at the top right here, like we see with this low right there. But whenever we are not comfortable above a high like this, for example, and we have an aggressive move towards the opposite side, that's oftentimes what we then see as a sweep right there, because we need those lows as liquidity. That's the way I like to interpret that, and that for me makes the whole scenarios a whole lot more sense. If it doesn't make a whole lot of sense to you, perfectly fine. Those previous patterns will do the job for you. Okay, then we are moving on to number 4, the trends right here. Now the trends become quite straightforward. This is actually from a previous video as well. Because for example, when we are bullish, then what are we actually looking at? Well, right here, we see that we have a swing low at the bottom. We are sweeping a swing low, and more importantly, we are running swing highs right there. Keep sweeping swing lows right there, and we are running swing highs. That makes us create this bullish trend. Now, when does a reversal eventually happen? Well, for example, we create that swing high right there. If we now start sweeping swing highs, and instead we start running swing lows right there, and we keep running swing lows, then we create a reversal, and the bearish trend is where we now run swing lows. To sum this up right here, to simplify this, when we are running swing highs, we are bullish. When we eventually start sweeping swing highs, we might be creating a reversal right there. When we are eventually running swing lows right there, we are bearish. We are creating a bearish trend. Now, there will be scenarios like we see here in the bottom right, where we might be sweeping a swing high right there. So we could potentially be on the edge of running that swing high to continue higher. As long as we trade back above a swing high and we still sweep it to then continue lower, and we still run swing lows, we are still bearish. So if all you do, for example, is just mark out swing lows and swing highs right here, then we see that we are currently running these swing lows right here to continue lower. Eventually, we start reaching a couple of swing lows to the left right here that we are actually sweeping. When we start sweeping these swing lows, there's a potential reversal happening right there. If we go down in time for example, in the 1 hour, we see this very clearly, because now we are running these swing highs, and we keep running these swing highs right there. Eventually, we arrive at a certain stage where we now start to struggle to run those same swing highs again. So we start sweeping swing highs instead right there. Now, we're not confidently running swing lows just yet. So we are creating this somewhat of a consolidation right there, where eventually we are not running swing highs. We keep sweeping swing highs right there, and we instead are running swing lows right there. And that's essentially what creates a trend, right? That continues right there, that continues lower. And again, that might seem very complicated, but that's so extremely simple, because when you really think of it, if we draw a line chart, for example, if we continue higher right there and we trade higher, then of course we are running swing highs right there. Now, might be an instance that we trade below a swing low, but we sweep it and we continue higher and we keep running swing highs. That's inherently why the bullish side is stronger at that moment in time, until we eventually arrive at a stage right there where we're now sweeping swing highs, and we keep sweeping swing highs. It's not that clear what we want to do. What is happening? Well, the bullish trend right there is simply getting weaker. That's it. If you remove all the labels, then all it really is the bullish trend right there is simply getting weaker, right? And then the bearish trend is getting stronger. That is why we are now running swing lows until eventually we start to create a reversal again and we start to sweep swing lows right there. And then we continue higher slowly again right there. So the bearish side right there is getting weaker. The bullish side is getting stronger. So we start sweeping lows and running highs right there. And before we dive deeper into that as well, again, then think of a consolidation right here. Because a consolidation, all it is then sweeping swing highs and we are sweeping swing lows. We're not running one side. It's as simple as it is. So if we take a look at this example right here, we are creating swing highs, we are creating swing lows right there. We are sweeping swing highs. At the same time, we're also sweeping swing lows. And we keep doing that right there. We keep doing that over and over and over until we start running one side. So if we now start running this swing low, for example, right there, then the trend starts to clear up again. Understanding everything here will allow you to understand how to take more winners. So how to understand the next target, for example. But on top of this, this also allows you to understand, which I think is even more important, allows you to understand how to avoid those silly losses. So I want to go over a few examples, but before we do that, again, think of your bias, think of your entries. If you apply everything that we just went over, if you now apply that to your bias, to your entries, then a question from me to you is, how many times are you doing the exact opposite of what liquidity is trying to tell you? And because you are trying to do the exact opposite, you are taking certain losses. So I want to give you an example of this, of what we were looking at during the Thursday live session in the MMT, and when we were looking at ES. So the thought process on Thursday was that we were essentially bearish on ES. So coming into equities open, we were bearish, looking to target these fair value gaps, looking to target these order blocks right there to continue lower, eventually the swing lows that we have right there as well. Now we went all the way into the lower time frame to frame the trade ID, where eventually we arrived at the 1 minute right here. Now, when we reached below this swing low right there, again, we're trying to confirm, we're trying to get an ID if we are sweeping or if we are running that. So we get a retracement back into the fair value gap, back into the larger order block. We see right here that we now start to continue lower again. Okay, good sign right here, right? If we can keep running these lows right here, it's a very good sign to potentially look for an entry to keep continuing lower. Now what happens, and what most would ignore right here, is this happens. We now get a large wick right there, a large potential sweep against our trade ID. So is it now is it wise at this moment in time to, for example, look at that fair value gap to continue lower from it? No, absolutely not. Absolutely not. So this is a very large red flag right there in, for example, your entries. If we now all of a sudden create this large sweep against your entry right there, then what will very likely happen? Well, we might still continue lower. If we can actually sting back below it right there again to then continue lower. Perfect. If that doesn't happen right here, there's a very big chance that we just continue higher instead, like we see right here. And this is not only with your entries, because most people just miss those early signs. Because if we, for example, go into the 1 hour time frame, again, we marked out this 4 hour swing low, right? That swing low towards the left on ES. If we now create a large rejection from that back into fair value gaps at this moment in time, is it very smart at this moment in time to look at shorts from this bearish value gap to keep continuing lower? No, because inherently price is telling you that it's sweeping this low at this moment in time at least, and that it's rejecting away from it. So if you now wait for the confirmation, for example, we see we have a larger rejection right there. We are taking out that rejection, the order block, the fair value gap, those are failing right there. So we can actually look to target these highs instead right there. And that is the important part, what liquidity tells you. It allows you to stay ahead of the curve. It's not that after the fact you realize, this fair value gap failed. Why did it fail right there? So to sum that up, you don't want to trade against a potential sweep. It doesn't even have to be a sweep just yet, but a potential sweep. So for example, here we are trading below this swing low. We trade back into the order block, into the fair value gap right there. At this moment in time, we can't accurately say if we are running it, that swing low to continue lower, or if we are sweeping to continue lower, at least towards, for example, these highs. We don't know that yet. So we need to let this develop. We need to wait at that moment in time, because most of the losses are quite unnecessary losses. As in, for example, you're just simply trading against a sweep right there. And because you're trading against a sweep, price is telling you it wants to potentially sweep it to continue higher, but instead you're looking to short right there because we had a bearish fair value gap. And that is again relevant for your entries, but at the same time, that's also very much relevant for your daily buys. If you want to actually become a price action trader and you want to start reading price action like a pro, then the MMT is for you. Link in the description. All right, perfect. Thank you.